the responsiveness that your team has to tenant inquiries and to maintenance issues, and how quickly your team is able to respond and deal with that, and how professionally they're able to do it and how friendly they're able to do it. All of those things really matter. And you may not be able to totally quantify all of them, but then you look at your renewal rate, you look at, tenant satisfaction surveys, and all of that stuff comes through and matters. And it creates value ultimately for your investor.
Hello, everybody, and welcome to another episode of Multifamily Chronicles. I'm your host, Adrian Danila. Our special guest today is Doug Motley. Doug, welcome to the show.
Thanks, Adrian. Great to see you.
Doug is the principal for Jack Lingo Asset Management. Doug, tell us a little bit about your company, how the company started, where you are in the process, size, footprint, all of that.
Sure. So we started JLAM a little over 13 years ago now, and it was really a spin out of a family office that had been largely investing in real estate for their own account, kind of on their own balance sheet. And we saw the opportunity to really build an investment platform and boutique investment and development company, out of that. And so not only the pipeline that they had, but also the opportunity to build and diversify across different investment strategies, all within the real estate space. And that's what we've done over the last more than a decade now. We have active investments in for sale residential. So where we are turning, building a community. So think of turning 200 acres into 400 lots. We put in all of the horizontal infrastructure, the streets, the utilities, the amenities, all of those types of things. And then we typically sell lots in partnership with a national or regional home builder. We also have traditional ground up multifamily development. So that's where we're turning 20 acres into 200 apartment units. The combination of those two is the build for rent sector, which we've gotten into in the last handful of years. And then we also have a commercial portfolio, which includes office and retail assets. Overall, we've got about in the neighborhood of 1,000 apartments in various stages of either operations or in development. We've developed over 3,000 lots, and we have a commercial portfolio of about 1 million square feet. And those collectively range from Southeast Pennsylvania down through South Carolina is where our portfolio is. From a business standpoint, we've got about $200 million of equity under management, and that equates to about $500 million of assets.
Doug, where is the company name coming from?
So the family that I mentioned is the Lingo family, which has been here in Southern Delaware, which we're based for over 100 years. And they got into the real estate business about 50 years ago, and over time had gotten into more of real estate development in addition to their core business, which is real estate brokerage. And so the patriarch of that family was a man named Jack Lingo, and that was the origin of their real estate brokerage name. And so when we started our business about 13 years ago as a loose affiliate of that, that's the origin of the Jack Lingo Asset Management name.
Is your company self-managing multifamily? Are you third-party managing, or it's a combination of both?
So on the multifamily side, a big part of what we find is important is the living experience that we deliver to our residents and our tenants. That goes from the physical space and the design of the community and the buildings, as well as the experience they have in dealing with people. So we wanted to make sure that we controlled and owned that experience. In addition, some of the markets that we operate in, they don't have a lot of third-party managers where you can just pick up the phone and call a national platform of management company. And so the combination of those two things led us to starting our own management leasing company when we built our first apartment development. And so that's how we operate all of our rental projects.
I'm curious about the maintenance services that you're offering to the residents. Are they mainly done by your own employees? Are they contracted out, or it's a combination? What's the percentage of in-house work that you do for maintenance?
Sure. So I can talk at a high level about that kind of from an approach and strategy standpoint. And I'm not into the overall responsibility of managing the day-to-day of that. But from an approach standpoint, when we initially started, it was triaging it with our own people and then utilizing third-party contractors to actually perform a lot of the work. As our portfolio has grown, our team's grown, and we've been able to staff our projects and our properties a little bit differently, where we have more internally self-performed work. Maybe it's about 50%. And then the more complicated things we outsource to very trusted and long-term partners that, we know are going to provide the quality, speed, and price that we're looking for to, effectuate those updates and changes.
Your model for maintenance, do you have employees that are assigned to each site? Is it a central team that oversees like a portfolio or an area, or it's again a combination of both?
Yeah, so I think that's a hot topic in multifamily operations these days of centralized versus decentralized. We use a decentralized approach where we have people assigned to specific projects. They get to know the residents better. They get to know the property a little bit better. The nice thing is, a lot of our projects are within relatively close proximity. So we can share resources if we need to for short-term situations, whether it's somebody's on vacation or if there's just a whole lot to do at one specific property and maybe some downtime at another, we can share some resources that way. But in general, we want to have the friendly face that the residents are accustomed to seeing and be able to quickly address any tickets, that maintenance items that they may have and need attended to.
Doug, you had an impressive career in real estate investment and development. I would like for you to share with the audience a little bit about your journey in real estate.
Sure. So getting into real estate was not really intentional. I didn't even know the role of real estate investor, developer really existed. Wasn't exposed to it in college or anything. I originally was in banking and consumer financial services. And I'm going to tell this because it'll come back in the story. But that bank, one of the primary things that they focused on was thinking of yourself as a customer. So all the employees, that was something that was very prominent in the internal education, the priorities of the bank. In my banking career, there was an event that happened where the bank I was working for got acquired by a much larger organization, and the culture changed completely. It went from one set of cultural priorities to something very, very different. And that was kind of the impetus to looking for other opportunities. And I was fortunate where a friend of mine made a connection with a real estate developer here in Delaware, and we really hit it off. And as I got to know him a little bit better, I got my first glance into what real estate development really entailed and meant. Shortly thereafter, I was able to join that company and got my first taste of real estate. And it was a small company, so entrepreneurial spirit as well. Over time, there wasn't one event that really triggered our philosophy. But as I got more and more exposure to real estate, I kind of made the mental connection of, if you think of yourself as the person who's using the real estate and what the things are that they're going to find important and are going to differentiate the experience for them or how they perceive that experience, then if you can incorporate that into how you're investing and how you're creating projects and developing projects, then you can be very successful. And we believe organizationally that if we're able to create and invest in places that you actually want to be, it's not a rocket science type concept, but if you think about all the most important experiences that you've had in your life, a lot of times where you were when you had that experience is also part of that mental picture that you have. And so we think about that as we're designing all of our different real estate projects, and when we're picking the types of projects we want to invest in, if they're existing assets, and really thinking about those characteristics and that philosophy. I started to kind of bake that philosophy a little bit at that first role, working with another developer. And then after 3 or 4 years, the GFC hit, and the market changed completely. And the economics to me of my compensation structure at that company changed. And it was really the catalyst for me to go out and start my first company. And that was over the next several years. I started a couple companies in different parts of real estate, one being a commercial construction company, another being a private equity fund platform where we were investing in distressed assets coming out of the GFC. And then ultimately, 13 years ago, starting JLAM and really with the intent of building out a really tailored and customized investment and development company.
So what are your responsibilities currently with your company, and what does a day-to-day looks like for you?
Sure. So I'm co-managing partner. So on my front, I'm responsible for our growth strategies for our company. Where's the next best opportunities from a big picture standpoint, identifying where market opportunities may be and market changes, and then starting to drill down into those and what's a specific investment strategy that we can put in place to take advantage of that. And then the next level down is, okay, what are the actual assets we're going to go buy that align with that investment strategy? So it's picking what we're going to buy and the reasons why we're going to buy it. And then also all of our capital relationships. So all of the investor relations, our equity and our debt relationships, and overseeing all those. So put simply, it's what are we going to buy and how are we going to pay for it? And then once we get to a transaction standpoint, that's when my partner kind of takes the lead and handles all of the execution and operations of either our development assets or our existing assets.
I want to go back a little bit to what you just said and ask the question, where are the best opportunities today to invest?
So it always changes, and we've built our company intentionally to be able to be agile and to be able to pivot to where the best opportunities are, where we think they are. And what that requires is to have expertise in development and acquisition and expertise across a variety of property types. So we've been very careful in the people and the team that we've built, in the processes and infrastructure that we've built to be able to accommodate that. What we find most interesting right now and what we look for big themes, things that are outside of our control. We don't control where people are moving. We don't control the aging of the population. We don't control interest rates. We don't control climate. There's a whole bunch of things we don't control, but we look at those from a top-down perspective and say, okay, where's the tide rising in these things that's going to impact real estate? And then how do we take advantage of that? And so a specific example of that would be the United States is short 3 to 6 million housing units, depending on which source you look at. That's not something that's going to get fixed overnight. That's going to take a decade or more to fix if there was enough capital put towards it, which is probably impossible. Then we drill down to certain states and say, where do people want to live? Or whether that's jobs and they're following jobs, or whether that's they're going there for the climate or for outdoor activities or cost of living or other reasons, and maybe the jobs are following them. So where do you have in-migration? Where do you have income strengthening? Where do you have job growth? Where do you have business or politically friendly environment? And kind of look for the intersection of a lot of those things. And if you can find those things, then try and find, okay, we found this place that people want to be. Now let's go find a property that really is going to be differentiated from the other things within that market. So residential housing is a space that we think is a very interesting and durable longer term opportunity. How you invest in that is a little bit of a different answer. There are some other things that we think industrial has some long-term durability. Data centers are very interesting, but we don't have that's a space where we don't have a competitive advantage and don't have organizational knowledge. So it's not a space where we're probably going to invest. There are other bigger, more skilled operators in that space. So we kind of know what we're good at and we know what we're not. So we really like multifamily. We really like build for rent. We really like some for sale housing in certain markets. And it's really trying to figure out how to find those best opportunities within that. And that's where the art and science really comes into play, of not just the math, but the more vision and gut as to what the experience is going to be for your residents.
You mentioned loving the balance of science and art in real estate. Can you share an example where this balance played a crucial role in a project's success?
Sure. So there's a project we developed called Showfield, which is a 166 single family home lot subdivision. And it is in a location in a coastal Delaware market. We could have developed it, just as 166 nondescript single family lots. Well, one of the nice things was the property itself had a little bit of topography to it, which lent itself towards us being able to design some things. But when we were looking at the property, it was an old farm. And so on that farm was a very unique barn, which had some amazing architecture. And then there was some stables. And then there was another ancillary building that I think was an old grain building. And so when we were designing the project, we saw an opportunity to hit a segment of the market that was really looking for, the high priced custom home segment of the market where there was no other product being developed for that. And so to really do that and command a premium, we put our heads together and said, how can we make this place feel special? How can we add character to something that was largely just a farm field? What we were able to do was, put in things like we built some massive stormwater ponds that were way too big for what was actually needed, but we made them, they're much more like natural ponds rather than just a stormwater facility. You could have a canoe race down them. They're so big. We repurposed to the grain building I mentioned. We moved it about 500 yards, put a working water wheel that we sourced from South Carolina. So there's this giant 12-foot water wheel on the side of this building, pump house, everything. So it looks like an old mill building that actually functions. We took the stables and we converted them to cabanas, and we built a pool right next to them, which is next to this old architecture barn that we refurbished. And then we built a new clubhouse. So we took some of the really cool existing structures that were on the property and repurposed them in a pretty creative way, I think, that we supplemented with new construction and provided kind of the best of all worlds. If you get the character from these old buildings, you've updated them to be current and durable. And then you've got the new modern amenities of a new clubhouse and gym and giant bar room and all of those things. And so when you combine all of those things, it really led to a project that was in very high demand in a segment of the market that there just was no other competition. And we really looked at that through a different lens of not just how do we get as many lots as possible on this property, but how do we deliver something that's going to be really special, something that we're going to be super proud of at the end of it, and that the people who live there are going to feel special about living there. And we, I think, did that very, very well. And that ended up leading to fantastic economics for us and for our investors.
Doug, you believe that nimble private investors can often outperform giant institutions. Can you provide a specific instance where this agility gave you a competitive edge?
Sure. So, I think there are places where, and I don't think it's an or, right? So I think that from an investor perspective, there are times when having exposure to the giant investors makes a lot of sense. And you can also have exposure to smaller, more nimble investors or investment platforms. And so I think you can have a perfect combination of that. I think when you compare and contrast the two, some of the places that we're able to win from an operational standpoint, say in the office environment, we've had a number of times where we've been competing. We've got a tenant come to us, tour our property, and tour a bunch of other properties in the market. And they've gone out to two different spaces to get proposals to occupy the space. We've been able to respond to those much quicker, understand what the tenant needs are, and provide a proposal that meets them. Whereas bigger, more bureaucratic real estate investment trusts or other organizations might take a month or two just to respond. And they don't even talk to the tenant and understand what their needs are. And so we've been able to run circles around them, and that's really helped us capture market share and examples like that. Another example in the multifamily space would be in really understanding the micro market that a property is in, and not just needing to desktop underwrite or desktop evaluate the market conditions of what rents are, but really being able to understand the difference between our property and the one, half mile or a mile away. You might not just be able to all pull it from a data source. It's much more of, well, yeah, if you walk through that, it feels totally different, and it shouldn't command a premium. It should be at a discount to our property. And if we just looked at the numbers, we'd be missing out on a significant difference in rent. But because we're very close to the local micro markets that we invest in and operate in, we're able to really tailor and dial in all of the, whether it's assumptions on a deal that we're looking at buying or developing, or whether it's, how much we're going to push rents or, incentives we may offer or other things like that at a specific property. It really helps us be much more refined.
Having co-founded a private equity real estate platform, what are some key insights or lessons you've learned about private equity investing in real estate?
On the capital side, well, I guess with most things with starting a business or raising capital, things usually are going to take about twice as long as you think they will. Time is definitely one. I think one of the benefits of, if you can structure it right, you need to be very thoughtful in how you're setting up your capital sources and aligning your capital sources with the actual business plan that you want to pursue. And if you have flexibility in how you can perform that business plan, it can put you in a competitive situation. So for example, a lot of times we may be competing against other more institutional funds that need to invest with a 3 to 5 year time horizon, because their whole business is based on raising capital, putting that capital to work quickly, and then getting that money back out with a return to get to investors within 3 to 5 years, and then kind of rinse, repeat, do it again. Well, if you can set up your capital where you don't necessarily need to do that, and you can say have a 7 or 10 year time horizon or even longer, a lot of times you can look through a different lens in your evaluation of an opportunity. And that may put you in a position to either win more deals or also just be able to have more things fall within the criteria set that you have. So if for whatever reason a property that you're looking at almost requires an 8 year business plan, say because it's got debt that can't be paid off until 8 years, well, that's going to kick out a whole bunch of potential buyers because they need to get out of it in 5. And if they're trying to sell it in 5 with debt that only has 3 years, that might be problematic. The opposite of that is if I can look at that deal and say, hey, I can line up 8 or 10 year money and I have no problem holding that asset for 8 or 10 years, you can be one of, maybe only one of one buyers at the table. So, aligning your capital and with your business plan, I think is a very important thing, or having the maximum amount of flexibility with your capital sources as possible is certainly important.
Doug, you've overseen investments across multiple market cycles. How do you adapt your investment strategies to navigate these varying economic climates, especially the current one that we're in?
Yeah, sure. So as I mentioned earlier, we look for macro things that we don't control, but then we see how we can take advantage of them. And often that's going into overlooked or underserved segments of the market that can benefit from those factors, and then finding the best deals within that. But that overlooked and underserved segments of the market is a really important point. So we're typically in lower middle market assets. So that might mean $20 to $60 million total asset sizes, which could be a $5 to $20 million equity check. That's sub-institutional. So there are many less players there. And that also, can mean being in secondary or tertiary markets. Again, less competition. And what we like about that is we get paid to be there. So we get paid a premium relative to being, right in the middle of Main and Main, or the sexiest asset class that there may be. So we like to be there. I'll give you a specific example of though how we adjust and pivot to the market conditions. So beginning of last year, we saw quasi-banking crisis or mini banking crisis with SVB, Signature Bank, and Credit Suisse, and all collapsing within a very short amount of time. We also saw interest rates go through the roof, and the whole lending market kind of got turned on its head. We'd seen some of those elements before when you went back 12 or 13 years to the GFC, and what we were seeing and hearing from lenders participating in the market. We'd seen that playbook before. There were definitely some differences this time. But what that made us think of was, hey, look, the lending market's gotten way tighter. There's a whole bunch of debt that's maturing in the next couple of years, and north of $1.5 trillion from 2023 to 2025. And you've got a bunch of lenders pulling way back on their willingness to provide capital in that space. So what we did was we stood up a private credit fund, and we are providing rescue capital, preferred equity, and mezzanine debt to qualified, very capable project sponsors for either new construction or recapitalizing existing assets in the kind of $1 to $10 million check size. So now have become a provider of capital, where we are coming in behind a senior loan and ahead of common equity. So we're sliding up the capital stack from where we typically are, but we feel like we're in a really good position to, one, as an operator ourselves, really understand the situation that the developer or the operator, the owner is in, get our arms around the operating assumptions and their skills there, and then really get our arms around the capital stack and be a solution provider to people that are in the position where they just need more time, maybe, and their bank is not willing to give it, or at least not willing to give it without paying down some of the loan balance. So we see that as a good opportunity for us to provide a solution to our borrowers, so to speak, but while also delivering, attractive risk-adjusted returns to our fund investors.
Doug, educating investors about real estate markets is a part of your mission. What are some common misconceptions you've encountered, and how do you address them?
Sure. So, a big one is that the national headlines are applicable to everything. So whether that's all office is bad, whether it's the apartments are overbuilt everywhere, whatever it may be, a lot of times headlines driven by national averages can be very misconstrued. And what we see and what we believe is that every market is different. Every submarket within a market can be very different. Knowing and understanding the nuances of that is really important. So, I've had a number of conversations with our investors or prospective investors about, I saw that, the apartment market is way overbuilt, rents are falling, and apartments are now, not a good place to invest. Well, you really need to peel back the onion on that statement, because there are a lot of apartment markets, maybe not the top 20, but there's a lot of apartment markets that are not overbuilt, don't have any supply issue, and rents are still growing. There are markets where Austin or Charlotte or Nashville, some of the big markets that have seen a lot of apartment development, rents may be great in some of the non-luxury segments of the market because they were not overbuilt. What was overbuilt was the brand new stuff that was trying to get $3,000 or $4,000 a month in rent. So really understanding the differences within a market is super critical. I think that's probably one of the biggest things that is out there, is really understanding the nuances specific to the geography that you're looking at investing in.
I want to talk a little bit about creating value, Doug. What's your approach to creating real estate investments that stand out from the crowd and deliver exceptional value to investors?
Sure. So it starts with, on the development side, it starts with the investment strategy of, are we tapping into a rising tide, so to speak? And are there some tailwinds demographically that we can benefit from? But specific to an investment, what we really look for is starting with the design of the project and what is the physical traits of the property that we may be able to capitalize on and really incorporate into the design of that community or that project. And then thinking through what the unit mix is going to be, what the unit types are going to be, what the physical characteristics. Is it 9-foot ceilings? Is it maybe 10-foot ceilings? Everybody's got a balcony. What's that balcony looking at? From big picture stuff as to how buildings are oriented, all the way down to very minute details like what type of light posts are we going to use. So we think about a whole set of things, and we have a very distinct set of guidelines that we kind of use as a guidepost there. This thread continues all the way through the life cycle. So it goes into, how are you selecting and negotiating and then dealing with your contractors who are building the project for you? How are you overseeing them? How are you ensuring that there's quality there that's going to stand the test of time? Because we are typically not a merchant type developer where we are looking to hold these assets for at least 3, 5, 7 years. We want to make sure that this is something that's quality built and done well. So we have processes for ensuring that. And then the operational side, which I think you might be pretty close to, Adrian, but the operational side is huge. We touched on this a little bit earlier, but like the responsiveness that your team has to tenant inquiries and to maintenance issues, and how quickly your team is able to respond and deal with that, and how professionally they're able to do it and how friendly they're able to do it. All of those things really matter. And you may not be able to totally quantify all of them, but then you look at your renewal rate, you look at, tenant satisfaction surveys, and all of that stuff comes through and matters, and it creates value ultimately for your investors. So really thinking about yourself as the person who's living in or working in the things that you own and that you develop or you invest in can be a great perspective to really help create value if you think about what's it like from their perspective.
Doug, what's the size of your operations team, your employees that actually run the real estate that your company owns?
So we've got about 4 people in our field development team, so that are overseeing or managing the actual construction and development of our projects. And then we've got, I think it's about 20 people in our management and leasing company that are overseeing, the day-to-day operations of our multifamily and build to rent projects. And so that's everything from senior management all the way down to our maintenance techs and our maintenance management, our leasing and property management folks. We're lean kind of across the board, but we size our team appropriately to the scope of work that we have.
Technology that's being used in a process on a multifamily side. I'm curious about what type of technology are you using, what challenges you're seeing with technology in general applicable to the multifamily part of your business, and what opportunities do you see out there?
You mean on the operational side, or including kind of the development side of things too?
Operational, yeah.
We currently use AppFolio as our property management platform that works well. I think I'm not overly close to this other than the financial reporting side of it. But, we do monitor ticket times and responsiveness to that, renewal rates, reasons for vacating, all of those things. We use the survey capabilities, to understand resident satisfaction. There's obviously AI is a big conversation piece in all of this. We believe that all of our tours are done in person. We don't have, you just get a code and can go give yourself a self tour. We believe in the person to person interaction there is important. We're not using things like that in that capacity, but I think that there's big opportunity probably on the building system side. And this is, I'm guessing, something that you're pretty sharp on, Adrian, but whether it's on thermostats or whether it's on rekeying locks or access to garage buildings, things like that, there's probably a whole lot of room to run in terms of implementing technology on that front. Curious, what do you think? What's your view on that?
I think automation must play a huge role in today's environment for a few reasons. One of the reasons is that we're all short on personnel. Having the classic deadbolt on an apartment door and having to carry keys from the apartment to the office and back, and then while you're holding the keys, pest control shows up and they happen to need one of the keys that you have, and everybody's like chasing keys around the property. I think that's extremely counterproductive. Summertime, when you have a high volume of turns on each property, you're gonna see a line of vendors line up waiting to get keys or to return keys, and your leasing agents, instead servicing residents and prospects, they had to do key management. This is a very outdated process, right? When you think about hotels, you have the ability today with just your phone to go to a hotel, never see any employee, like look straight to the hallway, go straight to your room, open the door, unlock the door with your phone, lock it back up, check in and check out. A completely frictionless experience. Yeah. And this has been done. It's been done in hotels for a while, maybe with the exception of like being able to open the door on your phone. That's a few years old. But the rest of it, the whole process of like cards and everything's been done, like access control's been done for decades. I think it's time for multifamily to embrace that. It saves a lot of time. It turns into more happier employees, right? Everybody's stressed out because it's a high volume of work. Having those tools at your disposal, at your team's disposal, make a difference. Technology also for managing work order workflows. Not all the apps are made equal. And what I've learned is that the general platforms, I won't name names, but large platforms that offer all the services like accounting, leasing, collections, maintenance, the maintenance part, it's always the fifth wheel. They only develop some basic maintenance function because they want to have everything in store. And it makes sense to have like a complete solution. When it comes down to what that solution does, it does very little for, it does very basic things for the maintenance teams. There's technology that's just maintenance specific focus that's quite amazing. And it gives you real-time KPIs that, beats by far anything that, the large companies develop, the Amazon type models. Yeah. I think that there's a lot of room out there for those. Having KPIs at your fingertips and also data integrity. For example, it's not like back in a day to where you would print work orders and give them around to techs and they bring them in and a leasing agent hits the close button without taking any notes. You don't know what was done there. You don't know how long it took. There's technology out there that prohibits that, forbids that. So only the end user, only the user that's assigned to that particular work will be the person that could complete that work order. They're not even allowed to complete it without actually typing notes, sometimes taking pictures. So that provides tremendous value to you and your operation teams out there, and it gives you a leg up. You're ahead of the competition because mostly everybody, honestly, probably still like 70-80% of the industry still operates the way I've described it. We're behind times. And the beautiful part is that technology is available. It just takes operators time to get to it, get their hands on it. Once they get their hands on it, they're gonna embrace it and see the benefits immediately. And I think it'll revolutionize the whole process and also save time too.
Yeah, that's what it's all about. Yeah, that's good to hear. Enjoy talking more with you about that, exploring that some more.
Absolutely. I would love to do that. Your philosophy on wealth creation, I want to go there next. You're passionate about helping investors build wealth through private real estate investing. What's your core philosophy on wealth creation? Could you share some core principles with us?
Sure. So, I'm not a financial advisor, financial planner. None of these are investment recommendations or anything like that. But, I think, once people get to a point where they've got an adequate amount of assets and can start to diversify into alternative investments, I do think real estate, particularly private real estate, is a great way to do that. For most of us who are taxable investors and unfortunately have to pay taxes, real estate can be a very effective way to invest tax efficiently. So multifamily is a great example where a lot of the income is shielded by depreciation. Now, ultimately, that income will be recaptured later on when the asset is sold, but that's at a lower tax rate than what ordinary income rates are today. So when you have the ability to have illiquid investments, so if you're investing in real estate, most of the time you can't just pick up the phone and sell it like you would a stock, but you get paid a premium for that. So if you've got enough assets to be able to take that risk or absorb that illiquidity, you get paid for doing so. Or you should require to get paid for doing so. And that's why, one of the reasons why real estate returns are higher generally than more liquid securities. So I think real estate's a great part of a balanced portfolio. And it's something that more mainstream investment advisors don't have the time to really research and find enough out about. And so that's one of the things we try and partner with investment advisors to provide a real estate investment solution through a trusted partner where we can provide the support and education to the investment advisor so then they can help determine which of their clients make sense to get a real estate allocation to. And then we can provide one option for them to then turn and do that.
Doug, you have recently become a private pilot. Yep. Can you share an exciting adventure you had flying and how does it parallels with your professional journey?
There's a whole lot of parallels between real estate and the private pilot journey. But, one of the fun things that I really love about flying is just the ability to explore. You don't have to necessarily file a flight plan and say exactly where you're going. So you can kind of just, explore a little bit within the confines of the flight rules. But last summer, I was fortunate enough to take my wife to a long weekend up in Maine. And when we coming back, we live in a town where the president summers. And so when the president is in town, there's what's called a temporary flight restriction. And within 10-mile radius of that, nobody can go into. And then within a 30-mile radius, what's called the outer ring, you can fly into, but you have to get special clearance. So this kind of came up at the last minute after we were already away. And so I had to figure out for the first time how to get that special clearance and kind of navigate through that. And so that was a fun experience, challenge to learn something new. But on the way back and coming back into town, we had to go through that process. But it's just been a really exciting journey and has also been helpful on the professional side. So a lot of what we do, as I mentioned, is from Southeast Pennsylvania to South Carolina. So maybe anywhere from a 5 to 10 hour drive away. Well, now all of a sudden that becomes a 1 to 3 hour flight. We have assets in Charleston, 10-hour drive. It's a 3-hour flight for me. Charlotte. Again, 10-hour drive, less than a 3-hour flight. So it really has made navigating things when we don't live near a commercial airport. It's made navigating, some of our other markets a lot easier. And it's a really fun way to commute to go see some of them.
Doug, we as leaders and executives, we're as good as our team is. Literally, we're the weakest link of our team. What are some qualities do you look for when building your team? How do you foster a collaborative environment?
First, I'll start with the point you just made is collaboration. Collaboration is one of the key tenets of our business. And, one of the reasons why we work together in the office, not remotely, is collaboration is key to what we do. And being able to walk down the hall or pop in the conference room and pull stuff up and talk through it, or pull out a plan set and talk through design things. We haven't found any other alternative to that works the same way. That collaboration is crucial. But in terms of building our team, and this is something we're in the throes of now as we're continuing to add people to the team, is really fit is a big component. And the personality fit is probably the first thing that we look for. And does the person get along with and add a diverse perspective, opinion set, and experience set to the team? So we don't want to have everybody nodding their heads, just sitting around the table. We want a diversity of opinions and experiences and perspectives. Think people that have run into other roadblocks that we may not have seen, people that execute things or have been exposed to different processes and can bring up, hey, I understand you guys do it this way. I've seen it done this way. What do you think? And we're always looking for that continuous improvement and ways to do things better. And we pride ourselves on being very agile and nimble, as we talked about earlier, but we do that in the confines or in a framework of institutional like processes. So a lot of our team has had some corporate or institutional type experience, and we try and take those things that work really well in that context, strip out all the bureaucracy and the noise and the things that slowed it down, and put just the important part into our process. So as we build our team, we're looking for people that fit, the people that have the drive and the energy. I'm a big believer in, I want to try and find people that are going to work hard and have a motor themselves and are self-motivated and are curious and intellectually, want to learn new things. And I shouldn't have to, leaders should not be in a position where they're needing to make people do things. It should be removing roadblocks to enable and empower. And so we are big believers in, how do we empower, find the right people and empower them to do great things and be really involved in rewarding work that can make a difference for our company.
I want to talk about the long game, the importance of the long game. And I want to ask you to share a success story where your company's approach has produced long-term results for investors. And what were the key factors that contributed to that success?
Yeah, that's a great question, Adrian. I think, just from a step back, the long game is something that's very top of mind for us. So we see a number of our competitors will make decisions of how do they make the most amount of money on a single transaction, not necessarily their investors. We are building a business that relies on and needs the long-term growth of our investors. So we make decisions that that's what's in the best interest of our investors for the long term. If we do that right, then our business is going to be, well positioned to continue to grow over the long term. We'll make money later, but doing the right thing for our investors is of paramount importance to how we think about every decision that we make. There are cases where we may own a property, something that we've purchased years and years ago. For whatever reason, it was a good opportunity for us to purchase our own capital internally. And maybe we bought it raw without any entitlements. And over the last couple of years, we've taken it through the entitlement process, and now it's ready to be developed. We might take that property to be developed, and we will recapitalize it and bring in outside capital or investors into that partnership that's going to develop it. Well, we could look to step up the basis and sell it to ourselves, sell it to this new partnership at the most amount of money possible. Say we get an appraisal and comes back at $10 million for the property. Well, if we do our underwriting and our underwriting can only support an $8 million purchase price, then that's what we're going to go. That's what we're going to value it at. We're not going to try and maximize to get the $10 million number for ourselves at the expense of the people coming in and entrusting us with their hard-earned money. So I think that's something that goes along with how I opened this statement is, we're not looking to maximize the dollars that we make on any given transaction. We're looking at it from a big picture standpoint of how do we ensure that we're delivering on the promises and commitments we've made to our investors as to how we're going to operate and how we're going to treat them, and doing that with a long-term view.
Let's talk about the future, Doug. What's your vision for the future of your company and the real estate investment landscape in the coming years? Okay,
so the second part of that, if I knew the answer to that, I'd be sitting on a beach somewhere. But in terms of the view of our company, we are definitely in growth mode. We have a bit of a contrarian view. When people are running towards something, we might go the other direction. And when they're running away from something, we might go towards it, because that can indicate interesting or compelling valuations. But as a lot of our competitors and bigger real estate players are going pencils down, we are aggressively looking at new opportunities. We're doing that very selectively, and you're having to look through a lot. But in an environment where there's a lot less buyers and sometimes some necessary or motivated sellers, and sometimes due to the lending market that we talked about earlier and impatient lenders, we're seeing some interesting opportunity. If you can figure out how to structure a deal that works and provides attractive risk-adjusted returns and actually get it started at a time like this, you're going to be delivering off cycle. You're going to be delivering when there's very little competition also delivering, which is going to put you in a really good spot, because anybody who starts then later is going to be delivering several years after. You're going to be stabilized and good to go. But the stuff you're going to be competing with when you deliver is going to be 3, 4, 5 years old. So off-cycle deliveries is something, that we think presents a really interesting opportunity. It's not every deal pencils anymore. It's very challenging to find ones that do. If you can have that vision to find, interesting ways to create value from something that maybe other people don't see, that's where it can get really exciting. In terms of the overall market, I'm one for the shorter term. I think we are going to be higher for longer from an interest rate standpoint. I think that is going to create more instability as it relates to existing loans and what's going to happen with them. So I think that'll create opportunity for those with capital. When you're a provider of capital at a time when capital is scarce, you get outsized returns. A lot more of the reward goes to those who are willing to provide capital at that time. So that's a big reason why we started the credit fund that we did, because we think that's going to be really interesting space over the next 12 to 24 months.
Doug, what are the things that keep you awake at night from a business perspective?
So fortunately, the vast majority of our debt side of our business is long-term fixed rate and low rate, all I think sub 4%. So we're in a very good position on that perspective. I think the construction financing is the thing that is the big limiting factor these days. And so as we think about our growth, it's how do we get creative? How do we secure the appropriate amount and structure of construction financing to continue to develop new multifamily and build for rent projects? And there's definitely some interesting and creative avenues which we've come up with and are working with our lenders and our investors on. So I think, that's one. I think the second is just finding the right people, making sure we have the right people in the right chairs. The roles and responsibilities are clear, and that we are all rowing the boat in the same direction in a way that's going to create the most amount of value for our enterprise.
Doug, we're only around for a limited period of time. Some will argue a short period of time. How would you like to be remembered? What would you like your legacy to be?
I think personally, it would be a kind person who was very thoughtful and creative and made a difference. And then from a company kind of perspective, more professionally, we like to think that we leave the places where we develop or invest better than before we got there. And so the projects that we do, if we're developing, trying to make sure that they're beneficial to the community and add something to it and are really representative of the direction we'd like to see the community go. And when I say community in that sense, I mean the broader area. I don't mean the specific project. So, how do we do things that people who live around there are also going to like? Because we tend to have roots in the places we invest in for the long term. And so we want to do things right that the people who live there or work there or shop there are proud of and excited to be at, and things that we're proud to, have on our tombstone and say that we did, and that our investors would be proud to be part of. So if we have that as our North Star, we think that, we're going to do well over the long term and be thought of hopefully well in the long term as well.
Doug, for those in the audience that are watching this episode, how can they get in touch with you if they want to, reach out for an investment opportunity or for just about anything?
Sure. So our website is jlamre.com. I'm on LinkedIn. That's probably the best way to find me. Doug Motley, CFA. Would love to connect with anybody who's interested in talking shop. Love talking real estate.
Doug, it's been amazing having you on. It's been a great hour. I can't even believe that it's been an hour already since we started. That's awesome. What are some final thoughts? Some final thoughts that you want to share with the audience.
Real estate is a really exciting space. It's always changing. We try and, as an organization, be a great resource for people who are interested in investing in real estate. We've got a very strong track record of executing exactly what I've talked about, today, is building and investing and developing creative, different places that ultimately people are proud of. And whether anybody who's involved in any segment of the life cycle there would love to connect with anybody who's interested in learning more. And thanks for the opportunity, Adrian. Really, really nice to spend time with you today.
Yeah, it was amazing. I hope to get you back here soon for another conversation. Thank you, everyone, for watching us today. This is Multifamily Chronicles. I'm your host, Adrian Danila, and I want to thank again Doug for being here with us today. I hope you have an amazing day.